So today, welcome to Grid, chapter, I don't even know anymore. It's the 9th month of the year, so I'm gonna assume it's
Maybe 6.
it's number 6. But how we started in February, right? So we should be at 8, but that's okay. Number 6.
He's an engineer, guy.
Yeah, on accident. So I shouldn't be up here. I am an engineer, guys, so all this real estate stuff, all of it. Okay, so today we're going to talk about how to maximize investing vehicles, and I remember when I heard the word vehicle for the first time in terms of like ways to pass money through. It's basically an account with rules applied to it. So I always heard the word vehicle. I'm like, okay, that was a car up until I was 20. Then they talk about investment vehicles and IRAs and insurances and all these different types of account where you can leverage the money that goes into it, because it's all about these weird rules associated with it, right? They said, hey, this account has rule X and this account has rule Y. Put your money in them, whether how you're going to use it. So today we're going to talk about how to maximize investment vehicles, primarily self-directed IRAs, and then the second part of I think big boy investing, I call it, which is like syndication. Because syndication is like when you're getting to the millions, and it's really important because we all start. I know my first real estate transaction as an investor was a fix and flip, and then my second one was a seller finance, and now I'm learning how to put together funds and earnings and things of that nature. So it comes with the territory, but it's pretty cool and very powerful. So on the slides. Leader intro. I'm a leader. My name is Eric Perez. I'm the Chief Operating Officer of the Figueroa Team and all the businesses associated with it. And that's the long and short. I am not a financial expert. I'm reading off slides for that reason. So take that into consideration. We're gonna have go back real quick. We're gonna have 2 guests. Actually, let me see. I got my man Brian. B or R?
B. Brian.
B? Brian?
Brian, yeah.
It's Brian, right? I thought I get confused, Brian. So I have I have your bio, but it's not on my screen, so that's not good for me. But I have Brian and this other individual on the screen. I can't remember. Let's go back to the first slide. Here we go. JP Brian Martinez is JP Dada. That's wild. So that's gonna be fun. So and JP Dada, so that's pretty interesting. And what's your expertise, Brian?
I am the Syndication Solutions Manager for Newview Trust.
This is what I'm talking about. This guy has a title that has syndication, and he knows what he's talking about. And JP left. I don't see him on the. Well,
Yeah.
don't worry about that. JP will come back. They always do. So we're not legal experts, financial experts. We're just to keep it going, keep it moving. All right. Go 3 slides forward. 1, 2, right there. Sorry. There. Real estate syndication is a partnership between several investors. Now, that's exactly what it is. It's some form of partnership, typically fused together through financial necessities, but sometimes you'll see syndications with general contractors, even on lead gen side. I've seen syndications in the real estate world like, hey, this guy is a cold caller. He secures a deal, and at the end of the process, he's getting X amount for the transaction when it's all said and done. So ultimately, syndication is really partnerships that are fused together through many means of the investment world. So it could be financial, it could be skill set, it could be access to certain resources and things like that. And that's really what it is. It's ultimately a partnership. And what is a self-directed IRA? Self-directed IRA allows you to hold alternative investments in a retirement account. So unlike traditional IRAs or Roth IRAs, which are often consist of stocks and bonds, so what you're purchasing with the money you put in there is essentially parts of companies to leverage that money and to grow that money. A self-directed IRA provides a broader selection of investment options like real estate. Ultimately, you can combine these two. You can combine these 2 concepts and open up your real estate investment world, which is, we're going to have an example where the sponsor, the primary person who sets up the syndication, really the person who finds the deal, gets small skin in the game through his IRA, able to raise the rest of the capital, and it shows how you can make massive returns in that space. So let's talk an example. Mark. Oh, good. Mark is my guy. Mark's my guy. Mark finds a deal for $1 million bucks, and we call him the sponsor in this case. And as the manager and operator of this deal, so he's the one who found the opportunity, within the investment world. He puts in 5% of his equity, about $50,000. Can be from his self-directed IRA if he has that money in it. Okay. He raises the remaining 95% of equity from the investors, right? It's $1 million deal. This could be $1 million deal for a down payment. This could be the total cost of the project. This could be a lot of things, okay? And Mark is responsible for managing the day-to-day operations of the deal. There's a straight split syndication, which is the most simple, especially real estate agent. It's like 80-20 split, right? 70-30, 50-50. So let's start with a straight split. So this is the easiest way to do it. And the idea split, depending on the percentage of each side of the split, are for all returns, cash flow, and any profits associated with the deal. Oh, perfect, 80-20. For example, if the deal uses an 80-20 split, that means 80% of all returns go to limited partner investors, meaning the people that Mark used to raise the money or that portion of the syndication to actually acquire the deal. So the major sum goes to the major sum of the money involved, right? So 95% of it was put in to this group of investors, 80% in this deal primarily is going to go to them first. The remaining 20% will go to Mark as a general partner, or really the person who found and structured the deal, so to speak, who syndicated the deal. This is the same whether the return is $1. So if it's $1, 80 cents is going to go to the 95%, equity stakeholder in the deal, and then the 20% is 20 cents is going to go to Mark. Same for $100,000, $80,000 to the 80% side, and $20,000 to 20% side. Those types of deals are what Mark and the sponsor, that situation, he wants to be as liquid as possible so he can get into as many syndications as possible, because the main, I don't know, I can't use that word. The main return, the main goose egg is going to go to the passive investors who put 95% financing. Now, the reality of it, and this is the truth of it, Mark, in this case, got to get that property to perform. So it's, what's 80% of zero? It's zero. So if Mark structures the deal, gets it together, and there's minimum or no returns on the deal, doesn't look like Mark's going to be able to get any more money for that type of syndication. And in the investor space, your reputation is absolutely everything. If you look at when it comes to pulling funds, what I'm learning now, you got to start with a small fund so that you can have performance on it, and then people will give you more access to money. Same thing in business. I was talking to the previous chief business officer of Zillow, and obviously his reputation with Zillow has now literally had people throwing money at him all day long based on what his performance was. Same thing as our investor space. You get into a bad deal, everybody's going to know. Every time we have to raise money, they always want to see our last 5 deals. They always do it. Doesn't matter if I worked with them before, it's like, hey, let's see your last 5 deals. Even hard money lenders have wanted to see that. So everybody wants to see your resume and your performance on it. Which is why the majority of us start on small projects but fix it flips that we can fund ourselves because we don't have access to that level of capital, right? A more complicated version of syndication, I'm probably going to butcher this, so you're going to have to help me later, and I'm going to make you redo it, is the waterfall method. And I actually learned this method about 2 weeks ago for the first time when it was in terms of fund, not actual deal. And we're going to go through that specifically. So this utilizes preferred return, or PERF, which many investors love to use. And that is basically is that if a syndication includes an 8% preferred return, that means the first 8% of earnings on a month-to-month basis, the cash flow or profits from the sale, go directly to the investors and the other limited partner investors. So for example, if you get a 10% return on the property, you're Mark, the person who syndicated the deal, 8 goes to your investors always, and you get 2%. That's why having a performing property or syndication is so important, because if you net even at 8% month over month, you're not getting $1 as the sponsor, the person who actually found the deal. The investor gets 100% of the first 8% of the returns, and the general partner Mark, they only get a piece of the returns if the returns are above that actual 8% mark, which I did just say. Here's another example. Let's say you invest $100,000 into a real estate syndication with an 8% preferred return. The first year, the returns are 8%. That means the investors get the full 8% return. In other words, you would get $8,000 or 8% of your original $100,000 investment. Mark, as a general partner, does not get any piece of that.
Sorry, it was frozen.
Oh, okay. Nice. While this does not guarantee that you receive the full 8% returns, ensure that you get preferred treatment for the first 8% of returns. Once again, if the This is all saying that the property is performing, or the deal is performing, or the community is performing, or the fund is performing at that matter. And it is supposed to encourage Mark, right, to manage the property, right, make sure. I mean, it depends on what you bought, but making sure the deal is profitable, exceeding returns above 8%, or Mark doesn't get a single dime, and that's not good, right? If you put some skin in it. So. What happens beyond the preferred return? So what happens when the 8% threshold is reached? In the waterfall model, the next 2 percentage points worth of returns activates a different split for the property. For example, any returns between 8 and 14%, say, might go on a 70-30%, 70-30 split, meaning everything post 8% is a 70 and 30 split. This is not upfront. It's not from the straight split. It's from after the preferred return is made. 70% to the limited investor and 30% to Mark as the general partner. Once you hit the 14% threshold in this example, the split may change again. Perhaps it's time to 50-50. And you basically set the thresholds when you go into this deal accordingly. So you can structure it a multitude of ways, and that's why the performance of the property or the investment is so important, because when you get into more complex syndications like this, without a performing portfolio or property, there's not much money for the person who secures the deal. Cool. Let's see. The waterfall structures often a win-win, as it's a great alignment of interest. A general partner wouldn't take on a property unless they were fairly confident they could produce returns above and beyond the perf rate or return rate. And the general partner is incentivized to work as hard as they can on behalf of the property and your investment to make the asset perform as well as possible. And the better the property performs, the more you get paid, and the more Mark, the sponsor, gets paid as well. Oh, cool. This is interesting. So LLC plus LP. So syndication is usually structured as a limited liability company or limited partnership. The sponsor participates as the general partner or manager, and the investors participate as a limited partner or passive members. Further, the LLC operating agreement or LP partnership agreement are vital documents. They set forth the rights of the sponsors and the investors. This includes the rights of distribution, which would involve the waterfall method, voting rights on decisions, and the sponsor's rights to fees for managing investment. That's also something that you could get paid on. The LLC or limited partnership structure is very similar to the setups of other private funds in the VC, venture capitalists, the private equity, and venture debt space. Such legal entities are there to protect both the sponsors and the members, which are the investors, if the deal goes south. And here's the structure of it. This is pretty interesting. So this property would be on your left, or this building on your left, has multiple people associated with that, with the managing member being the sponsor on the left-hand side, and the investors be on the right-hand side into this LLC. Now, on the contrary, the limited partner has the general partner, which is the same sponsor as Mark in this case, with several limited partners involved in this partnership. So this allows investors to get preferred return on money year after year, and the ability to participate in the upside profit, which will depend on the amount of money they invest. Does it matter between the two? I'm asking, does it matter?
Say it again.
Like between these two structures, what is different about this? I'll ask you one here, I'm sorry. So we'll see. Did you know it matters? Accredited investors. For the most part, syndications are typically only open to accredited investors. To be considered an accredited investor to the SEC, you must either have an income of at least 200K each year for the last 2 years, or if you're married, have a combined income of at least 300K for the last 2 years, or have a net worth of at least $1 million, excluding your primary residence, either individually or jointly with your spouse. So this is funny because I tried to join one of these apps that let you get into pre-IPO, and they literally ask for all these documents, because they're literally like, hey, you have to be accredited by the SEC, and these are the guidelines associated with it. So I didn't sign up for it because I was a lot where I had to get my taxes. That's crazy. If you qualify based on income, part of the qualification is the expectation that you will continue to make the income in the coming year. And syndications will typically ask you to provide a letter from your accountant stating that you qualify as for your 2 years of tax returns, or sending to a third-party site to validate your info. Self-directed IRAs. You can invest your IRA money into real estate, notes, business stocks, bonds, gold, but you need a qualified self-directed IRA custodian. Getting started. Step one, open and fund a self-directed account. So basically open one and put your money in there. Find the property that you'd like to invest in. Direct your custodian to fund your investment with your account. And then manage the investment in your account. So step 3 says provide your self-directed account custodian the specifics of the property you'd like to purchase with your IRA. How much money you need, where to send the funds, and if the documentation requires signing, you can choose to fund. You can choose to fund the entire purchase or portion of it with your account, which is kind of associated with syndication as well. If you have other people that go into the deal. And step 4 says money from the expenses and profits must flow to and from your account in the same proportion that is funded from the investment. So you need to mirror what goes out, comes in. Basic concept. There are rules you need to follow when using your IRA for real estate, but they're not complicated. Real estate owned in your IRA must be purely for investment purposes, so no primary residence, right? All expenses of the property must be paid through the IRA, not by you directly. So it comes out of the same account. That's like water, property management, etc. You can't use furniture you currently own in an IRA owned rental property. Are they serious? Any income generated by real estate held in your self-directed IRA must be paid to and returned to the IRA, not to you. And you cannot use your self-directed IRA to buy property from yourself or a family member. So it's strictly for investment purposes. But this is funny. Qualified, non-qualified person. Disqualified person, your friends and family, people you work with. Qualified person, anybody else. That's basically what it says. It says children, grandchildren. Well, don't borrow money from your kids. I would say that if you don't have it, definitely don't borrow from your kids. But they said don't be borrowing money from your family. I try not to even work with my family members or even my good friends, because that shit never works. And qualified person is anybody else. My last thoughts, really not my thoughts, it's really reading. If you want to invest in a real estate project, you can lend developer money for your self-directed IRA as long as you set up a self-directed IRA and show your qualified custodian. And you can raise cash from other people that have a self-directed IRA to help you fund your deals. Now I get it. They don't want you taking your grandmother's retirement fund. Now that makes sense in the previous. I get that. I get that. There's so many possibilities, and knowing how to use this tool, add rocket tool to your retirement account. So I'm going to end it here. I'm going to bring up Brian. I don't know where this guy went, but I think he's gone.
Here.
I don't know. Is he now?
Yes, he is. He must.
Prove it. It's actually here. Actually, well, can I have you too? Because I know you've done some syndications. You don't want to come up here, or you didn't get your beard trimmed?
That's right. This is true.
Facts. Here you go.
Hashtag facts.
Hashtag facts. Okay, cool. Let's. Oh, JP.
There
JP's
we
here.
go.
Nice.
Hey, JP,
I
how
want to
are
let you know that I am here to straighten your panel.
you? Yes.
Yeah, it's working. All right, cool. Can you pin my boy JP? Right.
Hello,
you can take a
everybody.
seat. Very friendly. Very full. It's great. I don't know what I should say. What do I do with my hands? In your pocket. Whatever, right? So, JP, can you hear us?
Oh, yeah, I can hear you. Yep.
Thank you for coming on, man. So, let's have you do the intro first, and then Brian and then Mark.
Sure. You just want me to intro? Is that what I heard?
Yes, please. Yes, please.
Okay, sure. So my name is JP Dada. I'm the founder and CEO of Vantage Self-Directed Retirement Accounts. We are a self-directed IRA custodial firm based out of Scottsdale, Arizona. We do business nationwide. We have about $2.5 billion of assets under custody. Currently, we've been in business for about 18 years. So, it looked like some of the basics were covered just now in the earlier presentation about self-directed IRAs. So I want to open it up for Q&A if you guys have actually specific questions. But ultimately, I think the easiest way to understand what a self-directed IRA is and how to use it is that, IRAs were introduced by Congress in 1974. And everything that you heard today about what an IRA can invest in has been available and legal to do since 1974. And I think the main misconception is, what the government allows IRA accounts and 401ks and retirement accounts to do, and what companies like Vantage or Schwab, Fidelity, E-Trade, or some of the traditional custodians allow their clients to invest in. So, a self-directed IRA is not anything technical different than an IRA that you can get from Fidelity or E-Trade, except for what the custodian is allowing you to invest in and who's ultimately making the decisions on in selecting the investments. So, with companies like Fidelity, you are limited. They're going to restrict you to only purchase investments that are stock market based. Companies like Vantage that are self-directed IRA qualified custodians are going to ultimately allow you to invest in private market investments, of course, real estate being the biggest asset class that we typically custody for clients. We don't give advice, we don't sell any products. So really what the role of a self-directed IRA custody firm is really to do the IRS reporting, handle the transactions based on the investments that the clients are directing us to purchase for them for the benefit of their account. And, I think as an audience member, the reality is, whether you are, you have a retirement account, whether it's a, 401k or an IRA, or you have an old 401k sitting somewhere, and your appetite, of course, is to invest in real estate. This is just a funding vehicle. Think of this, you can buy alternative assets or real estate inside of your IRA with cash. You can do it through syndications, like he just mentioned, through, partnering through entities, whether that be limited partnerships or LLCs, private funds, private placements, or you can also use leverage. So your IRA can actually provide the down payment for a property, and there are non-recourse lenders out there that will lend money to the IRA, and you can actually purchase, real estate with a loan with your IRA as well. So that should open up a lot of different structuring mechanisms that you guys can take advantage of. If you're out there raising capital, maybe you are a private fund yourself or a syndicator and you're looking to raise capital. Of course, this is just another avenue for you to raise capital in, is to create awareness. To give you guys some statistics, we have 70% of Americans have a retirement account. 4 out of every 10 households has an IRA. And but unfortunately, out of the $35 trillion that's currently held inside of retirement accounts, only less than 2% of that money is invested outside the stock market. So, the Wall Street firms have certainly done a really great job of making Americans believe that their only investment choice is in stock market-based investments, but it's simply not true. So the rules, like you mentioned on the couple slides there, are very simple. They're not complex. They're just certain people that you're restricted for your IRA to do business, transact with. And it's primarily limited to family members, but obviously other entities that you control or have voting majority and control over. Your IRA cannot transact, buy and sell, or exchange any type of sale or purchase with any of those disqualified or prohibited or disqualified persons. So it's just important to know who's on your disqualified persons list if you are a self-directed IRA account holder. But there's very little restrictions, to be quite honest. So like you mentioned, as long as you're not doing business with your family, pretty much everybody else you can transact with and do tax favored investing in with your self-directed IRA account. So, I don't want to spend too much time speaking. I really want to open it up for questions. I'm sure you guys have questions specific to maybe what.
We're gonna have one more person introduce themselves. So Brian, go ahead. 2 of us up here, man. Well, we all know you.
Hey everyone, thanks for joining us. I'm Brian Martinez. I'm with New View Trust Company. We're located right here in Central Florida in Longwood, not too far from this office. And JP, thank you. If I could give you a high five through the screen, I would. That was a great representation of what self-directed IRAs really are. So there's different types of IRAs, and there's a few other entities that you can use to be able to make these types of investments in real estate or alternative assets. So contrary to the slide, Roth IRAs, traditional IRAs, SEP IRAs, simple IRAs, solo 401ks, HSAs, health savings accounts, education savings accounts, any of these are vehicles that you can use. Yes, they are vehicles to invest in these alternative assets, whether it's a buy and hold piece of real estate, a fix and flip, a short-term rental, or you want to invest into a syndication as a passive investment. And there's active and passive investments, but the rules are it's got to remain at arm's length. That's the main rule. And there are specific family members you cannot do transactions with. That would be your ascendants and your descendants. So not all of your family is disqualified, just your parents, grandparents, your spouse, your kids, grandkids, spouses of your children and grandchildren. Those are the disqualified parties. And any beneficiaries you list on your IRA would be disqualified as well. So what the rule is I'm gonna give you an example to make it real easy to understand. For example, if I owned a piece of real estate in my IRA, I gotta remain at arm's length, so I can't put any sweat equity in the property. Those disqualified parties cannot be the ones to be hands-on and go paint that house or mow the lawn or put any work into that property. They also cannot live there, they cannot rent it. It's gotta be somebody outside of that disqualified party circle. But yeah, I definitely want to open up to Q&A. That's what the panel's for. I'm pretty excited to see, what questions you guys have for us.
Well,
Sweet. My name is Dwamel, and I am a syndicator. I'm the guy that was the sponsor on those charts. I am Mark on the charts. General partner, I do that for a living, and I deal with New View. Some of my investors have IRAs or solo 401ks, and they invest passively in our deals. We help get them 15 to 20% annually on their money. Because you mentioned it, 97% of retirement accounts are in Wall Street. And what our job is, or our mission is to get that from Wall Street to Main Street.
Love that. Yeah, I do see the market definitely evolving right now. A lot of people have really taken a big hit this past couple of months in the stock market, and they're exploring new options. And one of the biggest things they're looking at is putting their money into Main Street, into these syndication deals, or more buy and holds. I mean, yes, the interest rates are high right now, but it's not deterring people because they'd rather have their money and cash flow coming in. They know there's going to be cash flow versus putting in the stock market where they're taking these big hits.
So I have a friend that may or may not be in this room that has an IRA. He's not aware of that he can invest into real estate. How can he convert his to a self-directed or solo 401k to invest in one of my deals?
That's a great question. First thing is he qualified for the solo 401k? If he's investing into one of your deals, it's a syndication. I assume there's some leverage involved, correct?
Yes.
Okay. Usually when there's leverage involved, you're subject to a tax called UDFI tax, unrelated debt finance income tax. So you're only paying taxes on the leveraged portion of your profit. So your returns will be taxed a portion of it because it's borrowed money. If he's eligible for the solo 401k would be the first question I would find out. He must be self-employed with no common law employees. If he meets that requirement, I would encourage him to talk to a CPA and maybe start the solo 401k plan. He can roll over any pre-tax dollars, so a traditional IRA, a previous employer 401k plan, and then he can invest in that deal and not be subject to that UDFI tax. The next best thing would be a self-directed IRA, but he will be subject to that UDFI tax.
So the big thing is, what's the difference between solo 401k, and a self-directed?
So there's a lot of differences. That's pretty hard to limit to specific things.
Just a couple of high-level points.
Yeah, so the solo 401k has higher contribution limits. If you are self-employed with no common law employees, you can contribute up to $61,000 a year versus a traditional and a Roth IRA, you can only contribute $6,000 a year, $7,000 if you're over the age of 50. So it's superior in that the higher contribution limits give you a really big opportunity to jumpstart that retirement plan for yourself.
Hold up, Brian. Does everybody know that? Is that common knowledge?
I knew I was only allowed to put $6,200 in mine, I think it is.
That's amazing. Think about what you just said and how that benefits realtors. If you're a realtor, you think you can only put $5 or $6 grand into your IRA, but here's another product that lets you put 60 grand. So you could be putting a ton of your extra income into these deals or into this vehicle, which is,
And they're primarily safe vehicles overall, right? So
It's a retirement plan. You get to choose your investments versus having an advisor choose them for you. So no one's
and that
taking
advisor
commission
is
on
gonna feed, that advisor is going to feed it to them.
right, that's true.
Continue, man. But I just wanted to highlight that the solo 401k is really powerful, and it's a secret weapon. It's a different tax code altogether. It's not even the same tax code as the IRA, which is why it's very important what he said about the what do you call it?
UDFI tax.
UDFI tax.
Yeah, there's a few other things. They did the 401k plan. So if you ever needed to take a personal loan against it, you can borrow up to $50,000. It just cannot exceed over 15% of what the total value of that account is worth. So if you're ever in a crunch, you can borrow $50,000 from it, pay it back over 5 years. You can't do that in an IRA. So that's another perk of the solo 401k.
Do you have checkbook control?
You can either designate the custodian to be the record keeper, or it comes with checkbook control, which really means that instead of your money sitting at the custodian level, you are the trustee of that 401k plan. You can put it in a bank account and you can control your investments yourself. Check your control.
Basically.
Yeah, you're basically your own custodian.
That's also mind blowing.
Yeah.
These are really high level nuggets, man.
Yeah, thanks. JP, you have any input on that?
That would ultimately just echo, I mean, I think with the 401k, there's different reporting, the 5,500, so you'll have to make sure that you have somebody doing the 5,500 filing for you every single year. So even though you don't need a custodian, you have to make a decision on who's doing the record keeping on the account and whether you want to take on the responsibility. Obviously, you're taking on the responsibility of learning how to do that accurately and properly every year, or having to pay somebody else to do it for you. So just on the reporting side, just a couple differences there. But I think he definitely highlighted the main differences between 401ks and IRAs.
Someone explain to me the difference between LP and LLC, please. Dear
I'll
Lord,
let you
the
do
graph look the
Yeah.
same.
So typically a syndication is done in an LLC. An LP is typically more of a, when you have different companies coming together.
Oh, we got that sold.
Almost like a JV.
It's multiple LPs that coming together, the multiple companies that are coming together.
Company, yeah,
So
exactly.
it's multiple groupings of people that form a
Hey,
company.
there you go.
So like if you're in a syndication, right? So
You need a
take-
microphone, sir.
Oh, shit. Well, I was talking to you guys.
We have audience members.
That's all. They can hear me. They don't even hear what I say. But so do you go with other syndication groups to go into a deal? Or is that possible through, you would use LP? If
Yeah.
your company were to,
So an LP group, you would have several different corporations basically coming together. Whereas an LLC, you can have pure limited partners, such as individuals, such as realtors or.
so what is, you want to do a combination of the two? What if it's partly individuals and partly companies?
Keep it simple, son. You do LLCs, man. Just LLCs are really easy. They're simple, easy to set up. You create operating agreements. That's all that's like, yes. You read that slide.
Yeah, this like feedback, more information.
So I am not a syndicator myself. I'm learning about it, so I can add a little bit of knowledge to that. But yeah, what he's saying is the LPs are, say, so you have your LP, I have my LP. You're gonna raise your piece of the capital, I'm gonna raise my piece of the capital, and then we're gonna partner together to get that asset purchased.
Okay.
So you have your investors, I have my investors,
Oh, so you're just like a representative of your investors, basically.
and then we're partnering.
So it's literally micro syndications to a bigger syndication.
It's a good way to see it.
Yeah,
It's what it is.
It's more common like in legal, like when two law firms come together, they create a limited partnership.
There you go.
It's more common in like corporations. For real estate, LLCs are a little more common. Again, it's simple, it's easy, it takes less legalese.
I just know like when you go on somebiz.org, you click S Corp, LLC, there's like a whole drop there. I just pick whichever one I
It's a
like.
whole,
Yeah.
it's random.
Just randomly.
Good company. Okay.
JP,
It's not true, no, it's.
no, listen to it. I'm not a financial advisor. I said that earlier. JP, any feedback on that?
And he's running the companies, plural.
You know, we have accountants and stuff.
Nothing I want to add on the syndicator side or LP and LLCs. I mean, within self-directed IRAs, obviously you can invest in both types, but
Oh,
it really, it's a very, very common for people to co-invest with using any kind of entities. So I think it's just a matter, if you're an actual syndicator or someone who's looking, to self-directed IRAs as a funding source to raise capital, I would just encourage everybody in the room to make sure you're getting the right legal advice, to make sure you're raising capital legally, not just setting up an entity and going out and soliciting, investors. So just making sure you're talking to the right legal counsel to make sure that you've got the right structure and that you're properly set up to raise capital from accredited investors.
Yeah, Brian mentioned the word sweat equity earlier, and that is really the job of the general partner. The limited partner is exactly that. It's 100% passive. The job of the general partner is the manager. He's the one that's going out there and we're doing renovations to the property, doing the reporting, getting the team together, hiring the attorneys,
It's like are you managing occupancy rate? Like, are
Yeah.
you doing all
all the
that?
metrics,
Work maintains with that property as long as it existed under that current partnership. So you're married to that thing forever.
and married to those investors.
Of course, because you gotta pay them the rate for so whatever it is that you agree upon.
Yeah, we'll try to.
Or you hire a good property management team and they can take
Care that for you. But I mean, that's my route. I'm the hire guy, you know?
But you have to manage that property.
Well, yeah, you're still responsible for that property manager, so that's not fun.
Yeah, so we create business plans, and part of the team that we put together is property managers.
So question for you, at what point does it make sense for a property management company or an GC their own, like, because you're gonna source them anyway, right? But you're sourcing them through a margin, so you are losing money, you're not getting any service at cost. At what point does it make sense for you to look into those companies? That's something that you can provide.
Yeah, that's an excellent question. So personally, we do self-manage. We created a property management company that we treat as a third party, but it's really in-house. They sit at the table with us.
Yeah.
And it's not a profit center per se, which is, that's where the savings are. They're controlling that business plan. They're helping us execute that business plan. Same thing with contractor. I have general contractor license. We have our own crews. We have a construction manager. That's not me. But we have a construction manager that handles all of our renovations. For us, it was a control thing. How do we control costs? How do we control schedules, budgets, all that?
Could those companies be limited partners in syndication if they were to be profitable entities as well? They had money to,
I'm sure.
so could you technically be
Oh, I'm sorry.
in your own game?
team the system. Probably did.
You could, but most of the time that's already calculated in the underwriting before they even make the purchase. They calculate those figures and they know what to expect, and they're still telling their investors what the returns are going to look like with that property management team in place.
Got it. So those margins are based on what property margins, property management margins would be.
Just another expense.
Yeah, exactly. Yeah, we have our, just like you see P&Ls every day.
Yeah.
That's exactly what we look at, P&Ls every single day. So we're looking at what are our expense ratio, what are expenses line items, and within that we have property management, repairs, big renovations don't count as expenses because they're taxed differently, but that's a different rabbit hole.
Next time.
Next grid, part 8.
No, does anybody else have any questions for these fine gentlemen that clearly know a lot about this?
Can you use an active 401k for that company and transfer it over self-direct IRA?
Unfortunately, you cannot do that. If you're still with the employer, it's usually tied up. You can check with whoever the plan provider is and ask them if it's eligible. If you did move any funds into that 401k from a previous employer, you could access those funds.
Because I know that there's some companies that do like PCR, which is a personal choice retirement, where you can transfer a specific amount of funds that you have on your 401k, and you can do your own investment, like different stock markets and different shares and stuff like that, instead of going into mutual funds like a typical IRA would do.
Yeah, so you have to check with the plan provider if that's an opportunity. If you do a direct rollover to an IRA and you can self-direct it, then yeah, beautiful.
Yeah, so the question was, if you're employed and you have a 401k with your employer, can you use that to fund deals? Brian eloquently answered, short answer is no. You have to go through their provider, their plan, their people, because they're tied to that while you're employed.
So let me ask you a question. So we know that the millennial everything because before you're at your job for 25 years.
I can speak a little bit to that. I just add a little bit more flavor if you guys can hear me. Yeah,
You got it.
there's always triggering events that occur within a 401k, participating 401k that you have, right? So they are correct. You want to always check with your plan sponsor if the word you want to ask is whether or not your plan has what's called an in-service distribution provision. Okay, in-service distribution provision. That is the mechanism within a plan that allows for based on how they define it in that provision, what type of participant is eligible to take a portion of their money from the 401k that they have with a ABC company and roll that money out into an IRA where they can self-direct. Okay. So whether that be you want to self-direct and do particular stocks or mutual funds, obviously you'd probably be rolling over that money into a company like Fidelity. If you want to use it to invest in real estate deals or private market deals, then you want to obviously roll that money into a self-directed account. But that's the magic word is in-service withdrawal or in-service distribution. There's typically a vesting schedule. There's a parameter as to when you become eligible for that in-service distribution within a plan. As you can imagine, it's mostly large companies, large corporations that have a plan design within their 401k that allows for those things. Imagine if you worked, Bank of America or some of these bigger, large corporations where employees have been working there for, 10, 15, 20 years. So they use those provisions to not have everybody so restricted to the sub accounts or to the mutual funds that the plan is actually offering at the time. So, of course, if you are working for a small business, sometimes you also can, maybe, tap the shoulder of the CEO or the owner and say, hey, our plan needs to be a little bit more, have us have more investment options. And if they want to, make amendments to their plan document, then they're eligible to open that up to have a more self-directed option for their employees like we do at Vantage.
Excellent. So going back to what I was saying with I've had 5 401ks because I've jumped jobs in 2 years, right? Since I left college. I mean, that's just,
Is Veronica listening?
maybe she should. I don't even know about 401k here. Maybe not. So, is there a method to pool that money together? And would it be smart to just release that into a self-directed IRA and say if I wanted to pull those funds? Because that's actually, I'm 31 now. So that, the data says that my trajectory in my workplace is common for people my generation. So now I left college at 2013. So been working for some time. I know I do. They send me, I get letters in the mail, Mass Mutual, this person, that person. I don't even know what's going on with that. But at one point, that should be a very common theme today. So how are you targeting that millennial that has $30,000 in different 401ks that you need access to that money? And then what would you recommend that person to do with that money if they do have 4 or 5 investment funds from their previous workplace?
Yeah, I would definitely consolidate it so it's easier to track. That's huge.
You can take my mail, bro.
Then you know how much exactly you're working with. Once you know how much you're working with, then figure out where do you want it. Do you want it in a traditional IRA? If you're qualified for a solo 401k, do you want it there? And then from that point, you can self-direct it.
How do you qualify for solo 401k?
I was gonna say, what is that? How do I qualify for?
Self-employed with no common law employees.
That ain't me. I work here.
Is there a real estate professional?
How many people are 1099? You're qualified, you're qualified, you're qualified, you're qualified. You have any employees?
You have an employee.
You are the employee and you're the employer.
I have an LLC and I have me as the employee.
Okay.
You gotta fire yourself, man.
No, you are your employee. You're the employee and you're the employer. You play both roles of the business. So when you make the contributions to the solo 401k, you can make a contribution as the employee. It's $20,500 as the employee. Then you can also do an employer match up to 25% of your gross earned income. That's how you maximize it to that $61,000.
Oh, that makes sense.
Yeah,
So that goes straight from active income.
And if you are a real estate agent or a 1099 in the room, you're also able, for the solo 401k, you're also able to contribute for your spouse. So you don't have to have common law employees, but you are able to actually include your spouse in that.
That'd be 120,000.
Do you get 120,000 then? Or 61 total?
No, it'd be for each participant.
So 120,000.
It depends on if the income of each of those people is, you have to understand that the salary deferral portion of that 401k is going to be based on the income, right? The salary part that you're deferring into for that 20,500. So depending on what the income levels and what percentages can get, that's $61,000 that you were mentioning.
So hypothetically, it could be 61,000 per individual, correct? So you could,
Per plan participant.
per plan participant.
Now, you could have business partners as well. If you say you have an LLC and there's multiple business partners in that LLC, you could still be eligible for the solo 4K, and every business partner, they have to own over 5% in the business. They can all be plan participants as well. So that it doesn't have to just be you.
So section 8 of grid is with an accountant. And we really want to ask, like, what are the benefits of a real estate professional? If you guys are not claiming a real estate professional now, there's amazing, I'm not gonna say loopholes, but loopholes.
I mean, the rules, right? We don't make them, we just by rules.
Exactly. So, yeah, real estate professional, make sure that box is checked.
I think it's interesting because I think a lot of real estate agents just hustle and bustle all day long to get the next deal. And then that money goes in and out, like, without being intentional, right? So I think that I've learned a ton today, so I appreciate you guys obviously sharing that with us, and the slides actually have some information on those. So I think it's interesting that, you know, because to be honest with you, I know how much the agents on my team makes, and a very good agent makes over 6 figures if they're hitting that 40, 50 deals a year mark. And but they're obviously so hyper focused on what they're not going to hit 40, 50 deals a year if they're not hyper focused on doing what they are doing. But if you have a career, or I tell everybody this, if you think you're going to do real estate for the next 10 years, you should really be considering some sort of vehicles like this and taking portions of your money, your income, and putting it away every single time. You don't want your income dependent on the market, number one, and then you also want to have that exit plan, right? The exit strategy. I mean, there's that talk all the time that you don't go to real estate agents and the retirement party, right? It's usually they're literally, 86 years old, one more deal, I get it going.
And that is one of my passions, because I do see that. And what I would tell realtors is, let's say you're making 100K a year in your example. If you can live off of 50K a year, you can put the other 50 into an IRA or a solo K. And what you're doing is you lowered, again, I'm not a financial advisor, I'm a real estate investor. I'm not a financial advisor, not a CPA or nothing like that, but you essentially just lowered your tax bracket. You could lower yourself a couple times if you're doing it strategically. Think about that. So do I need 100K to live, or am I just gonna blow it on stupid shit, which is what we do? But if I can live off of less, Eric, and put that into exactly. Right, but think about that. So now you're paying less in taxes, and you're setting yourself up for your 86-year-old, whatever that example was, but you're setting yourself up for the future.
Yeah, and I think so is that, and I'll ask you, is that portion of income, right? I mean, about $100,000, I put 50K away into my IRA for the day, because I can, because I have $61,000 because I'm self-directed.
Okay, good question. Now, if you only earned 100,000 at the end of the year, 20,500 can be contributed, definitely. And then 25% of that 100K can be matched on the employer side. So potentially you could max that out.
Hold on, question mark. I'm a real estate agent. I have 1099. I don't have an employer matching me.
You are the
Oh,
employer.
you already, see, that's why real.
God.
That's why realtors need to have LLCs.
Employer, right? Oh, I got it. Okay. So that's, and then is there tax, well, no one's counting, so I'm not gonna ask the question.
That's good.
Oh, is there tax deferments associated with that?
So cool thing with the employee contribution, you can decide if you want to do free or post-tax dollars.
Got it. Well, if you know your goal is to get to a vehicle, what would you recommend? Not being an accountant, just being my friend,
I'm
right?
not a financial advisor.
You're my friend, right? I'm telling you, I got people
Right.
here.
There's nobody in the room.
I would rather not take the tax deduction and contribute it post-tax, because then I know going forward, it's gonna grow like a Roth IRA. It's gonna be tax exempt, and when you take it out, it'll be tax free.
So are you taxed on the total amount that it grew, or the not contributed?
You're taxed on the contribution.
Oh, that's great. So if you get your 50K and grow it 3x, you're just gonna pay $50,000 for taxes.
That's all you're paying taxes on.
Good Lord.
Yeah, as long as you're a good
I would
investor,
prefer
keep
the other
growing.
way. You prefer the other way?
Which is, I'd rather try to grow with as much money now. Again, I'm a investor, a little bit of a gambler. So I wanted to grow with as much, so in this example, we have IRS agent comes to the door. You know, well, no. That's why you have the beard, dude. Now I think it. Exactly. I just grew over neck on it. But yeah, so personally, it's and again, consult with your CPA, Eric. But personally, I have 50 Gs, right? I want that 50 Gs just to grow at a high clip. In his example, that 50 Gs now 35.
No, he said don't take the taxes.
Oh, my bad. I thought you said take the taxes.
Pay the taxes on the contribution now. And then
Pay the
when you
taxes.
pull that out, it's tax.
So you are paying the tax?
Yes.
Yeah, I don't know, exactly. I'm the opposite.
Yeah.
So does that not shift at a certain point in the progressive tax system? Because
I don't say you
at
CPA is up
$100
here.
grand, that makes sense.
The year you do the raw conversion, it could push you into a higher tax bracket, take the hit now. But it depends on your age, I mean, and your strategy, you know, do you have the next 20 years to invest and grow that account to, you know, exponentially? Are you gonna make great investments and are you gonna do maybe a fix and flip? You know, what do the returns look like?
What do we start spending our money to? Which one?
And everyone's strategy is different. That's why you need to talk to your CPA and learn the differences between pre and post tax.
Now, that account, once it's declared that way, sticks with those types of funds, right? That's not co-mingled at all. That's the thing that, so if you're gonna invest, for instance, you're gonna build an account, it'll be a post-tax account. Can that be put in with somebody else's account that is a tax account?
What do you mean by put in? It's separate.
No, and in these joint venture deals, right? So.
Oh, yeah.
Yeah, okay, so
That's
it doesn't matter,
something
it's not, so the return is personal to that individual.
Correct.
Okay,
But isn't that why the earnings from that property go back into the savings account, so it falls in the savings like rule set?
Yeah.
Okay.
Yeah, so we raised $1 million, that example that Eric did early on, we raised $1 million. Your portion was 100 grand of that $1 million. So all that profit that comes in, that first 8% of the preferred return. In that example, you get that, it's called pro rata as a fancy term, but basically 100 divided by 1 million, that's your 10% of that return.
Jay, you wanna add anything to that?
No, nothing to add. I mean, I think, you know, it sounds like some of the audience members are real estate agents. Some of them are just investors. Some of them are syndicators, et cetera. So the only thing I wanted to kind of mention on if you're a real estate agent, I always like to kind of say, you know, you have to be bilingual if you're a real estate agent. Not all real estate agents are created equal, but bilingual, I don't mean by Spanish and English and other languages. I mean that they have to talk the investor language. And if you are an investor agent, someone that's looking for people to, you know, fund deals that you're presenting to them, the IRA money is really sticky. You know, this because of the tax favored mechanism that it is. You know, you're buying, if you're, you know, whether you're fixing and flipping, you're buying and selling short term, you know, all that money comes in tax favored. So as an agent that's earning commissions on those transactions, the other benefit is that when you're in self-directed IRA investors making investments through you, not only are you, you know, this is long-term money for them. So even if you make them money, they're not going to take those profits and, you know, go to Vegas and spend money on it, right? They're not going to use it for other objectives financially in their life because they're just building it for the future. So, you know, I know, Eric, you're kind of smiling there. Maybe you will take the money and go somewhere to Vegas, but, you know, I'm just trying to, trying to highlight the fact that, you know, we have a lot of investor agents that are understanding that, you know, even though once they have a good client list of people who are using self-directed IRAs, sometimes they're going to be equity buyers into a deal. Sometimes there'll be a lender deal. So you have to be able to really understand all the different things you can do with a self-directed IRA so that you're attracting that type of client because they're sticky and they create, you said 50 transactions a year. I mean, so if you're looking for more transactions that you can create, you know, attracting self-directed money is going to be a better thing for you, in my opinion, than just, you know, having someone who's having to pay capital gains taxes on short-term capital gains that they're making through a flip. If they're, even if they're buying and holding, if you are in a non-IRA account, that money he starts to get other purposes. Oh, I got to pay for college now. I got to pay for, do other financial needs of the family that make you maybe not be the right, they may not do the next investment with you because that money that you made them now needs to be used for something else. With an IRA, it all comes back to the IRA. They're ready for the next deal and ready to next, for the next statement for you to show them. So you could definitely increase your transaction volume by attracting this type of clientele.
I have a really weird question. Anybody can take this. So the income that I'm now recontribute back into the IRA from that investment I did, how is that in a way, does that go against my 51 or my 61,000 contribution, or is it?
Those are returns, so they're treated different.
They're treated somewhat differently.
And real quick, before he answers, the naming matters. So it's not an IRA. You're asking a question about a solo.
Okay, I'm sorry. You're right. I just they're all the same. They're just
They're not the same.
Yeah, it's just your ROI returns from your investment.
right. Then you don't have to. There's no cap. Like you can contribute another 61,000 that year to that. In addition to
The next year, if you already maxed out.
Sorry.
contribution.
okay, if I were to be at zero again, I'm still collecting income from that.
Outside of the returns, we're.
Yeah, outside of the return. No problem.
Yeah, correct. And there's one thing I want to mention. There's earned income, there's passive income. If you have a rental property and you're collecting rent, that is passive income. That is not considered earned income. Depending on how you file your taxes, of course, but only earned income can be contributed to an IRA or solo 401k.
Why don't we learn taxes in high school?
Yeah, and
Earlier more. I'm exhausted. I don't know about you guys.
yeah, but that is brilliant. So syndication, another thing that's powerful for cash investors is the depreciation, because they are owners, they get to participate in depreciation. And this is the last year of 100% bonus depreciation, by the way.
10 years.
You can bring it, you have 15 years to do it, as long as that deal is still alive. If you sell the deal, then you get all that recaptured. But you're tax deferring.
So quick question on that, on the different types of income, right? The passive income, is there a recommended transition of that passive income into some, because it can't fund a 401k, right?
So I'm assuming you're a real estate investor, you have some rental properties.
Yeah.
This guy does everything.
Love it. So get with your CPA. I mean, I'm not giving you financial advice, but what I've seen people do you manage your own properties?
Yes.
Potentially, you could create an LLC, pay yourself as a property manager, pay the taxes. There is FICA taxes, which is really important. If you're paying the FICA taxes, it's considered earned income.
Yeah. I do a salary every month for that reason, just to kind of work around that type of stuff. Because
That's our income.
yeah, earn it, yeah, exactly. So I would salary.
We're not
myself
serious.
based on that. I get it. I was just wondering if there was.
You file a Schedule C at the end of the year? Okay, then yeah, it's earned income.
Yeah.
And what's really cool too is, JP mentioned the capital gains, short-term capital gains for flippers. That's why flipping houses.
I'm not mad, bro.
Is not investing. I don't think it's investing.
It's definitely.
But
Do something with that money after.
yeah, it's working. But a long-term investment gets taxed at a lower rate, which is not a CPA, but around the 15% mark. Long-term capital gains, JP mentioned the short-term. Flippers get hit at a higher clip. But
Is it treated like capital gains almost?
it's still capital gains. It's just long-term. There's different categories.
That's a 13-month. I think it is. What is it? It's 13 months.
I'm not a CPA, man.
I just wondered.
Love the hat though.
Sorry.
Very good.
Any more questions? All right, guys, give it up for JP, Brian, and thank you so much for coming. We got rained out a little bit again today. We don't seem to do well with the rain, but God willing, next month we'll be back on track. So, the first Wednesday of every month, right? Second Wednesday of every month, we're here at Grid. And I hope to see you next month. Thank you so much for coming.